Hot stock trends are like pumpkin spice season, loud, overhyped, and gone before you finish your latte. Don't invest like you're FOMOing at the mouth. Hi, I'm Phillip Smith, financial planner with Tide Pool Wealth Strategies, helping you figure out how to retire with confidence when you're nearing retirement and helping you build a plan that adapts as life changes when you're already retired. Welcome to
the perfect retirement plan.
If you're about to retire or even recently retired, you've probably heard more than your fair share of can't miss investment advice. A friend, a coworker, maybe that one guy on YouTube swears by the next big stock or crypto play. And it's tempting, right? Some new crypto coin is up 3,000% in 4 hours, but then you never hear about it again. The idea that you could double or triple or quadruple your money just by acting fast, it's very enticing. But when you're retiring in a place like Oregon or anywhere really, a good, thoughtful plan beats a great story every single time. You can probably already tell, but if my intro didn't offend your discerning sensibilities already, here's where we're headed today. We'll start with why hot tips are so appealing. Then we'll talk about the psychology behind that fear of missing out, or FOMO, why consistency outperforms excitement, and how a plan can help you stay grounded, especially when markets get noisy. By the end, you'll have a pretty good idea on how to retire with a calmer mindset and fewer regrets. We've all been there. Someone leans in and says something like, "Don't tell anyone, but this stock is about to explode." It's usually followed up by, "I cashed in all my palladium," or "I dug up my old oil well rights to go all in on this one." It hits that same part of the brain that lights up when someone whispers a secret. It feels exclusive, special, like you're about to get ahead. But here's the catch. Investing isn't about being first. It's about staying invested. Real long-term investing is about a focus on fundamentals, buying into something that you want to participate in through market ups and downs. It's not a quick flip. It's not a bet. It's not gambling. Most people chasing tips aren't buying opportunity, they're buying adrenaline. And retirement planning isn't the place for adrenaline. You've spent decades building wealth. Now, the goal is protecting it and using it wisely. The problem is, the financial world rewards noise. Every day, you'll see headlines designed to make you act now, panic now, buy now. But the truth? The investors who win are the ones who sit still when everyone else runs in circles. I love seeing commercials for new ETFs, especially the thematic and trend ETFs. I love them because those companies are basically paying to display a banner over investment that reads, "Phillip, this is a thing you don't want in your clients' portfolios." Makes it really easy for me. Think about it. Vanguard, BlackRock, Capital Group, they generally make commercials that advertise the brand, not a specific investment. If a specific stock, ETF, or mutual fund were really a great option over the long term, like over decades, its performance compared to its peers would tell the story on its own. It wouldn't need a multi-million-dollar ad campaign telling you how great of an investment it is today or how it's poised to explode. Don't approach investing like you're FOMOing at the mouth. Fear of missing out is powerful. It's why bubbles form and why people buy at the top and sell at the bottom. Behavioral economists have a term for it: herding bias. It's that instinct to follow the crowd, even when you know better. You see everyone else doing something and think, maybe I should do that too. Here's what's interesting. The pain of missing a gain actually hits harder than the pain of taking a loss. That's why retirees sometimes feel worse about not buying that stock that went up than they do about losing money on one that went down. FOMO isn't rational, it's emotional. Behavioral research from Morningstar shows just how costly emotional investing can be. Their study, Mind the Gap, highlights that investors on average earn less than the very funds that they invest in because they buy high and sell low, usually out of fear or greed. Another report from Morningstar on investor behavior notes how volatility triggers reactive decisions, turning long-term investors into short-term speculators. These studies aren't meant to scare anyone, but they're a reminder that FOMO is a powerful force, and without a plan, it can cost years of progress sometimes. And that brings me to something deeper, the real gut punch for many people who are about to retire. The real vulnerability begins when the paycheck ends. During your working years, market swings don't feel personal because your income keeps coming in. But when you stop earning and start drawing or distributing from your savings, everything feels personal. One bad withdrawal decision, one panic move, one chase after a hot stock trend, it can undo a decade of good habits. The danger isn't in the market itself. It's in letting emotions dictate your next move. And if you're about to retire, emotions can be your biggest financial threat. Your working years were about accumulation, but now it's about preservation and purpose. Every dollar has or should have a job. And chasing a hot stock because someone else made money on it doesn't fit the job description. Let's shift gears. If you zoom out and look at the investors who succeed long-term, they're not the ones timing markets or predicting trends. They're the ones who stick to a plan. Is it boring? Maybe, but is it effective? Absolutely, at least most of the time. The data is there to say absolutely, but can't give any guarantees on anything, right? Think about it this way. Would you rather have an exciting investment story or a dependable retirement income? One gives you a good headline, maybe a good story to share with friends. The other gives you peace at night, like you can sleep as a result of it. And consistency doesn't mean doing nothing. It means making smart, deliberate moves that fit your bigger picture. It's reviewing your plan, rebalancing when necessary, and ignoring the noise. Here's what's funny. People call disciplined investors lucky, but luck looks a lot like patience and preparation from a distance. Excitement feels like momentum. Confidence feels like clarity. They're easy to confuse, but they couldn't be more different. Excitement fades, confidence sticks. When someone gives you a stock tip, you feel excited. When you review your plan and see that it's on track, you feel confident. Excitement says, this time is different. Confidence says, I know what works. Excitement checks the app every hour. Confidence checks in once a quarter. Excitement needs validation. Confidence already has purpose. So how do you build confidence instead of chasing excitement? You start with alignment, knowing what your money is for, how long it needs to last, and what risks are worth taking. A good plan connects those dots and reminds you that you don't need to win every trade, you just need to keep winning at life. If you're retiring in Oregon, your plan isn't about guessing the next tech stock. Well, I mean, it shouldn't be about that, right? It should be about making sure you can kayak the Columbia, go tide pooling at the coast, spend time with your grandkids, or give generously to your church or nonprofit organization that you prefer without worrying if the market is open or closed. A solid plan frees you to focus on what matters most in life. And if you want to dig deeper into how discipline plays out during market swings, check out the podcast episode titled The Income Replacement Rule May Fail You in Retirement. It's on our YouTube channel, it's on Spotify, or wherever you get your podcasts. Well, most of the place that you get your podcasts. Let's take some action on this. First, identify what drives your financial decisions. Is it excitement or confidence? Second, review your plan and see if it actually matches your values and your goals. And third, when someone offers you a hot tip related to investing, pause and ask yourself, does this fit my plan? If it doesn't fit your plan, it's just noise and distraction. Life's too short for financial noise. If this helped, subscribe and share it with someone who's about to retire or recently retired and considering crazy, hot, trending topics for investing. For more conversations about how to retire in Oregon with clarity and purpose, check out the other episodes of The Perfect Retirement Plan. And remember, it's not about having the smartest financial advisor, the most money saved, or the highest probability of retirement success. And it's definitely not about finding out about the hottest stock trend. The perfect retirement plan for you is the one you act on. And today I'd also add the one that you stick to. It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purposes. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and are not representative of Type Wealth Strategy or Cetera Wealth Services, LLC. All examples are hypothetical in nature and for illustrative purposes only. The opinions contained in this material are those of Phillip Smith and not a recommendation or solicitation to buy or sell investment products. This information is from sources believed to be reliable, but Cetera Wealth Services, LLC cannot guarantee or represent that it is accurate or complete. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities offered through Cetera Wealth Services, LLC, member FINRA, SIPC. Advisory service offered through Cetera Investment Advisors, LLC, registered investment advisor. Cetera is under separate ownership from any other named entity.